listening to the Spicy Dividend. Hello, everybody, to the first episode of the Spicy Dividend. Yes, that is my podcast name, and it is Dividend Grinder's official podcast, a true passion project. So why am I starting this project, and why the hell is it named the Spicy Dividend? Well, I'm going to tell you because, look, I love dividend investing more than any other person on this planet Earth. There's a reason my name has dividend in it, Dividend Grinder. I get it. I appreciate dividends to no other. But let's be real. If you start doing the educational route, which I was doing on YouTube, trying to put out educational formal videos, it gets repetitive, it gets monotonous, it gets old really quick. There's only so much you can teach. Education videos on YouTube are a dime a dozen. There's so many good educators out there, the PPC Ians, the Kenny Robinsons, the Joseph Carlsons. Those guys are great. If you want pure educational content, I highly recommend them. If you're ready to take the next step up and go to more advanced educational knowledge, check out Ben Felix on YouTube. He's a guy that does not get enough love. BEN space FELIX. He's from Canada. He's from Ottawa. He's awesome. And pretty much is going to harp on you that in low-cost index fund is the best way to go, and he has much analytical data, pretty much beyond the beginner steps, definitely more intermediate and advanced tips on why certain studies indicate that a low-cost index fund is the best. But with that out of the way, we're going to have this podcast divided into 4 sections. We're going to have the opening bell. We're going to have what irks me today. We're going to have the diamond dividend, and we're going to have my closing statement. So before I get into the podcast officially, let me just say, I am not a licensed financial advisor. Anything on this podcast is not financial advice, strictly for fun and entertainment. Do not take anything that I say on here for granted. Like I said, entertainment. Now that the legal jargon is out of the way, let's get to the opening bell. And we break out of the gate. It is the opening bell. So let's talk about the actual name of Dividend Grinder. So where did Dividend Grinder come from, and why did I name myself that? Now, if you go on Instagram and you follow any of the accounts that just dedicate their full entire profile to their accounts, a lot of them are dividend investors, but they'll show their Acorns account, their Stash account, M1 Finance account, Robinhood account, whatever. There are so many dividend whatever accounts that it gets corny after a while. There's almost every single iteration of dividend out there. You get a thesaurus out, get a dictionary out, pretty much any combination with the word dividend is out there on Instagram. So why would I choose Dividend Grinder? Well, look, obviously I love dividends. That's pretty much a given. That's not that hard to figure out at this point. But grinder actually means a lot. And no, I'm well aware of the sexual connotation of grinder, okay? Let's get that out of the way. It has nothing to do with sexual orientation. Get that out of your head. All right. I strictly mean, look, like the actual, like what the white man says, like I'm grinding today, got to go on my grind for work, blah, blah, blah. What I'm saying is that honestly, everything in my life has been a grind, and that's what I'm trying to portray to my audience. And the reason I'm making this opening bell statement today is because of what I actually posted on Instagram today. So I actually posted on Instagram, which is just at dividend_grinder if you're interested at all. But what I posted was just that my account, including non-invested cash, has reached 30K. And a great milestone, one that, you know, the market's at all-time highs today, so it's probably not going to last. It'll probably dip a little bit. But that being said, I like to celebrate every single milestone that I get. It just reminds me of how far I've come. And that kind of brings me to it. So a couple of the comments, like Dividend Snowball and Snarf's Portfolio. I love those guys. Great accounts. Pretty much said, you know, holy crap, because you invested a lot of money this year. And because I had in my caption underneath the photo, I said, look, I started the year on January 1st, 2019 at a total account value of $14,950. And it's currently, you know, just a touch over $30,000. It's like $30,080 when I turned off the app after work today. So I ended up putting in my own money, like $13,500 to $14,000. And, the comments from these guys were like, my man Snarf was like, oh, I need to get more disposable income. And Dividend Snowball's like, holy crap, 15K in a year. And it's only been half a year. You know what I mean? And, in the back of your head, if you're just starting out investing, you might think to yourself, you might look at an account like mine, like I'm being snobbish, I'm not being humble at all. I'm kind of bragging like, oh man, look how great my portfolio is and how high my account value is. Obviously, to many accounts out there, my account's puny, but to a lot of people, 30K is a lot. And that includes, it's a lot to me just a year ago. I started the portfolio, and I've said this multiple times, but if you're new to the channel, new to this podcast, I've started the portfolio in February 2018, February of last year. So a year and 3 months, a year and 4 months, however you want to calculate it. I started at $350. Now, in the back of your head, you're saying, oh, well, it must be nice if you can spend, $15,000 in half a year to put to your portfolio. Guys, if I had that much money, like disposable, to just blow right off the top, don't you think I would have started my account a little higher than $350? What's the point? Why would I start so small if I had such a large sum of money at my disposal to just put it in? So I commented back, just trying to give some inspiration, just trying to say, look, I'm true to my name. I am the dividend grinder. I grind out everything that I earned in my entire life. So I'm looking at the numbers, and I commented this, and I just have some additional thing to add. So I officially put in around $13,600 of my own money this year alone. Since starting from January 1, about $13,600. But of that, $600 came from dividends, $300 came from, and these are nice rounded numbers. Obviously, they're not calculated fully correctly, but $600 from dividends, $300 from referral incomes on M1 Finance, $500 from YouTube from AdSense income, $50 in cashback apps, $50 in credit card cashback, $800 from the Vegas trip that I used for my bachelor party, but $800 was not used. I had a budget of $2,000. I saved for like over a year for that moment, and I ended up saving $800. So I didn't gamble at all, despite my nature. So $800, and I just took that $800, put it right into the portfolio. $1,000 of that $13,600 was from random gambling wins. This year, $1,000 was from my bonus paycheck, and that was like 95% of the bonus paycheck, and $600 was from a tax refund. So you total that all up, and that is $4,900 of non-typical, non-paycheck related, unless you want to count the bonus in that, but not typical funding. So you have to build up multiple streams of income. You've heard that so many times before from all the wannabe entrepreneurs on YouTube. Oh, you need multiple sources of income. This is what every rich guy does. He has multiple sources, 7 sources of income. Here's an example of like 30 that I have, blah, 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 blah. You get the point. It's a broken record after a while. But what I'm trying to get to you is I don't have all the money in the world, okay? I really don't. And when I first had my job at a college at Penn National Gaming as a staff accountant, I remember going to the Christmas party when I was like 6 months into working there. And I told my boss at the time, I'm like, if you gave me $45,000 and I made $45,000 a year for the rest of my life, I would pretty much be happy for all of eternity. Now, obviously, I'm short selling myself there, but it gives you an idea of the attitude that I grew up with. I did not grow up with a lot at all by any means. I was so fortunate to get a scholarship to such a small school, East Stroudsburg University in college. I don't know if I would have been able to pay for books, to be honest. That's how, hurt I was. I had like $100 to my name in high school, no debit card, no bank account, no credit card. It was literally in a lockbox underneath my parents' mattress. And then throughout college, I finally got a debit card, but I barely used it because there was like $190 to my name. I think at the highest point in my college career, I had maybe $400, $500 to my name. But, that's typical, right? All the college kids in America are broke. And then, by the way, now you have all these people that are saying like a college degree is worthless. Don't get me started on that crap. But anyway, I graduate out of college and I have maybe $400 to my name. and I still go gambling, and it was actually like a quite a good run for gambling with little money. But that's just my mentality. I grew up with not that much, and I really grinded everything that I had in life. Look, I'm not that smart of a guy, and I had to maintain a 4.5 throughout my college career to maintain the scholarship. Those were the demands. So it was really testing, but very worth it. It really showed me how to persevere through stuff. Like I said, I'm not the most intelligent guy, but I'm a grinder, and that's why I named my channel the Dividend Grinders, because I just grind my way through every aspect of life. It might not be the most intelligent way, as a lot of people have criticized my portfolio over and over and over, but you know what? I wouldn't want it any other way. I know that it is true blue collar income, even though I'm working a white collar job now. I know where I've come from. I know my background. I've had no financial education at all throughout my entire life. You think you go to college with a business management degree and a specialization in accounting, and then I become an accountant for 5 years and I work in consolidation systems, and I'm a financial analyst. You think that you would learn stock market items along the way, and I worked for a public company at Penn National Gaming. But no, you really didn't learn that much. And, I will say that's kind of a blessing that I worked at Penn National Gaming, because that's when they split they split GLPI out of Penn National Gaming. So they made Gaming Leisure Properties, which is a real estate investment trust, or a REIT. And that is now the highest position in my portfolio at the moment. But I would have no idea what a REIT was. And, my dad didn't put anything into his 401k until he was, I think he said 46 years old, which just breaks my heart. He said he had, he couldn't take a 401k because he had to pay for my freshman year books after my freshman year is when I got this scholarship. And that just breaks my heart, because knowing what I know now with financial education is just like, oh my God, like I couldn't imagine not putting into my 401k, let alone all the other stuff I currently do with my ridiculous $30 minimum a day into M1 Finance. But to know he wasn't investing until his late 40s, and he's so reliant on one stock, I'm not going to say what it is, but the point I'm trying to make is I'm trying to be as humble as possible. Yeah, I'm sorry if any of my posts saying my milestones come off as bragging or showing off my ego or whatever. I promise you it's not. It's honestly to show you, look, this is a guy who came from literally no financial background, with no trust fund or no, secret income stashes or anything like that nature. I had very little in my name, grew up with very little, and it's all self-educated at the age of 26. I didn't have a credit card until I was 27 years old. Last year is when I got my very first credit card and finally getting cashback apps. So look, I'm still learning. I'm still new to all of this. And I'm trying to show you this is what the power of grinding it out, making a consistent deposit into your brokerage accounts. It doesn't matter what your holdings are, as long as their holdings are somewhat solid and you don't have any super risky funds. The funding is always going to be the most important aspect to anything that you do. And to just, drive home the point of this is, how do you think it's possible for someone like me, who just has all dividend paying stocks, to go from $350 to 30 grand in 1 year and 4 months? I mean, that's unheard of. If you would have told me when I started my account at 350 that it's going to be at 30 grand in 5 years, I would have been ecstatic. Look how far it's come. And what I want to address to you is that a lot of people say, like, oh, I don't have the discretionary income to put into my portfolio like you do. And yeah, look, I admit $30 a day is very high. It's an aggressive target. I'm just at a point in my life where I'm debt free. I only have to pay half the mortgage, and that's all I have to worry about. And it's a very cheap mortgage. We live in Bumblefuck, Pennsylvania. But what I'm trying to get at is that when you do put your portfolio first, your investments first, your future first, you become more frugal along the way because it forces you to be. And that's a really good thing. Look, I've kicked a lot of my gambling habits because I'm so laser focused on my portfolio. And that's what you want to be if you're a dividend investor. It's all about long term. It's all about funding as aggressively as you can, a savings plan. is the greatest thing you can do. There was an episode on the Plain Bagel, another YouTuber from Canada who does financial education videos, definitely more on the educational side, but he had a rant saying like the stock market won't get you rich. And one of the studies he had there was they interviewed like the top, as many people as they could in like the top 10% of wealth in the nation. And more than 80% of them said, more than 80% of participants in the top 10% of the nation in terms of financial wealth said that the most important thing to them is a savings plan, a dedicated savings plan. And a dedicated savings plan and a dedicated funding plan, in my eyes, are the exact same thing. You have to save the money in order to fund your account. So they go hand in hand. This has been the opening bell statement. Hope it gave you some positivity. I hope it gives you some enlightenment as to why I name myself Dividend Grinder. It means a lot to me. Seriously, it's coming from the heart. Everything that I do on my channel comes from the heart, and I'm trying my best to help you guys out, trying to inspire you, trying to show you that any Joe Schmo with no financial background can do it. But with all that good stuff out of the way, let's find out what's irking me today. What is making Dividend Grinder so angry today? Oh, I'll tell you what's irking me today. Look, I cannot stand when people try to just force their financial opinion onto someone else's portfolio, or they force ideas that, look, hey, you have to do this, you have to do this. There's a little saltiness from me just because I got so much crap for that Roth video that I did that it's now private. It's essentially like why I don't have a Roth, why it's only a taxable, and oh my god, the backlash I got from that.
Well, what are you talking about, Dividend Grinder? It's tax-free growth, and you have to max that and then put the rest in the individual.
Blah, 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 blah.
Suck!
First of all, why do you care what I do? I don't understand. Like, what? Some of you try to help. I get it. Some of you are just trying to help. You don't want what's wrong for others. I get that. But at the same time, what does it matter to you? Are you doing that? Are you this perfect, Warren Buffett investor and you have everything? Oh, I have so many tax advantage accounts and I have my Roth and I max it out and all my dividends are qualified. I don't have any REITs unless they're in a Roth, so I don't have to pay taxes and blah, 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 blah. I'm just the wonderful God of investing himself. So, after all that, just drop it. Like, it doesn't affect you in any way. Like a better question would just be like, just curious, why don't you have a Roth? And it's just like, that's it. You don't have to like say your 2 cents. No one cares half the time. The amount of criticism that people get out without being able to take it is ridiculous. But let's get away from the Roth crap. So going back to the, people have to put their 2 cents into it. Let me tell you just a tiny story and why it was just so satisfying to hear the response. So I am on Reddit, right? And I follow the M1 Finance subreddit a lot. I just posted there yesterday, actually, complaining about, not complaining, I was just offering a suggestion to the M1 team just because a lot of their employees do check that subreddit out a lot. I just said, hey, maybe give us the option to see your true percentage gains versus the money weighted average return. M1 Finance pretty much defaults you to a money weighted average return. I'm just like, hey, it would be cool to have an option. And I showed a picture of my portfolio just saying like, it's showing that it's up 20.5% when in reality it's closer to 7 to 8%. And there was a lot of agreements. I think actually Joseph Carlson, I think he's Pied Piper on Reddit. I could be wrong about that, so I apologize if I'm completely botching this. But, and then he's like, oh, this is why money weighted average return is better. If you deposit it so much so late, if you're dollar cost averaging, money weighted is clearly superior, blah, 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 blah. You got to upvotes, people agree with it. I'm not saying I disagree with them because obviously I do a lot of dollar cost averaging. I mean, for Christ's sakes, I'm putting in $30 at minimum every single trading day. So you would think I would be a huge proponent for money weighted average. And I'm not saying to completely disband it. I just, said to the creators of the M1 team that, hey, maybe give an option. I don't foresee it. I could be really ignorant here, but I don't foresee it as being that difficult of a process. And, Joseph made a lot of great points, but at the end of the day, it's like, you know what, dude, I just don't want it. I don't know what to tell you. It's like, I don't care if you think it's beneficial. A lot of people think it's beneficial. Every single brokerage account besides M1 goes with, the true dated percentage returns. Anyway, I just thought that was funny. I'm just like, yeah, great explanation. I don't care. But anyway, I think one of the posts on the subreddit was, what do you love about M1 Finance? Why do you use it over other brokerages? Blah, blah, blah. I think it was one of the teammates actually put it out and they wanted to get feedback, positive feedback or any criticisms. And one of the comments was, I like fractional shares. Like, that's the only reason I'm in M1 Finance. And, that's a great answer. That's pretty much why I'm in M1 Finance, because of the fractional shares. And it allows me to be a lot more flexible, pretty much do what I want on a daily basis, blah, blah, blah. And he went on to say, like, look, I only have one stock in my portfolio. It is Amazon. And I love M1 Finance because it lets me buy Amazon really cheap and as often as I want. And I'm like, that's very, I'm reading this to my head. I didn't comment at all. I didn't say anything. I'm just like, that's very interesting. This guy's just going all in on Amazon. And I, for one, you've seen my portfolio. If not, just, look at my cash flow challenge videos on YouTube. But what I'd like to point out is that probably 1 minute after he posted that, he only has Amazon in his portfolio. Some guy, and I think it's hilarious too, because the guy commenting on the other side of an M1 Finance subreddit is going to be this financial guru, right? Like, he's God of all things knowing. And, like, come on, give me a break. Like, you're going to be the enlightenment that gets through to this guy. You're going to say something that's going to be like, that's going to make him like, oh, yeah, of course, I didn't see that. Wow, what was I thinking? But, 1 minute after he posted it, no lie, it was like a big paragraph just saying, wow, you only have one holding. Shouldn't you be diversifying more? Aren't you worried about risk? Aren't you worried about downside? All the best investors in the world do diversifications, blah, 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 blah. And he's giving this whole 10 cents. Now, look, I'm not saying I'd like agreeing with the guy saying, or disagreeing with the guy saying, like, having one holding in your portfolio is great. I would never argue for that. But to my point that I'm trying to make, what do you care? Why is it any of your business? Do you have a perfectly diversified portfolio? Are you happy with it? Good. Then why do you got to plead your case to other people that your way is the only way? I mean, what if you have completely different goals? What if he doesn't give a shit about dividends? What if he just wants growth? What if he works for Amazon and this is a way for him to, kind of fuel his motivation for working there? You don't know the circumstances of another person. You don't know their goals, which we'll get to later. And his response was perfect. After seeing this long paragraph of, why diversification is superior, why you should hold more than just Amazon, all his response was thanks, but I'm not looking for financial advice. And the thing that made this so satisfying was that his original post saying, I love fractional shares, I only have Amazon, got probably 3 upvotes. And then the response, that long paragraph, probably about 2 upvotes. And then the just savage killer just saying, thanks, I'm not looking for advice, probably got about 20 upvotes. And it was so quick. And it was just, and you're damn right that I was one of those upvotes. It was so quick. It was so satisfying. And it's like, who are you to give financial advice? Unless you're a financial advisor. And even if you're a financial advisor, who are you to tell anyone where they should put their hard-earned money to?
Denied.
Yeah, you can give advice if they ask for it. If they're asking for advice, if they're opening their portfolio to you and saying, what are your thoughts on my portfolio? That's a whole different story. If the guy's just saying, I love it for fractional shares, I have Amazon, and then you just go on this tangent about, why that's such a shitty idea. Why? What is the point of making that comment? What is the best case scenario there? Is the guy going to come back and be like, oh yeah, holy crap, you are right. I'm going to diversify tomorrow. I'm going to sell Amazon and I'm going to buy a, low cost index fund and SPHD and VOO and blah, 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 blah. It's like, Is that your best case scenario? And you feel, are you patting yourself in the back, whipping your dick around because it's like you converted this guy? Are you like, one of those Mormons converting into the religion? I don't understand the point on critiquing other people's portfolios. Now, look, I get it because I've seen many people's portfolios and I'm looking at their holdings and I'm going, Jesus Christ, what is happening there? But it's like when Bruce Wayne was talking about AGNC and like the dividend getting cut. And I'm just in the back of my mind, I'm like, what person looks at AGNC's chart and all their dividend cuts and wants that in your portfolio? But at the same time, it's like, but it's their money. They can do whatever the hell they want. When people tell me all the time, like, I don't know why you gamble. It's like, because it's entertainment. It's fun for me. I budget for it. What do you care? I'm sorry. Are you having fun going out partying every weekend? Are you smoking cigarettes? Are you vaping? Are you driving like an idiot? Are you spending money on cars? Everyone spends money on stupid shit. But with investments, it's no different. People can buy whatever they want. You are in no right to tell someone what they need to do with their portfolio, with their hard-earned money. That is what is irking me today. Hope you enjoyed the rant. Let's move on to the diamond dividend.
It's time for the diamond dividend.
All right, diamond dividend. So the whole point of this segment of the podcast is to pretty much just spotlight a specific stock and just give my thoughts and feelings about it and how it relates to dividend investing and how, maybe it should work into your mentality when it comes to investing, especially if you're new. Just hear it out. So 3M is one of those blue chip companies that has been around for such a long time. And anyone who has been following 3M knows that it has taken quite a dramatic dip in recent times. So as of April 23rd, 2019, the stock price was $219.50. And then quickly going from April 23rd to June 3rd, we see a price of $160. So an absolutely massive drop to go from $220 to $160. A huge capital appreciation hit. Now, if you're new to investing, your first mentality is, oh my God, you're going to have a little panic. You're going to see your account just be extremely red, especially if you're heavily weighted into 3M. And you're going to have your first mental battles with the stock market. So when you're in dividend investing, you kind of hope for these kind of things. And you hope that it dips on either like bad news. You just hope that it's nothing that changes the fundamentals of the company. And with 3M, it was just poor outlook. They didn't like the first quarter results. They didn't like the outlook for the rest of the year and for future periods. They essentially lowered guidance, saying we don't think we're going to be able to make the amount of revenue that we projected last year. And so, as a dividend investor, as long as the fundamentals of the company, as long as they're not, like selling off half their company, or if a new investment they make completely is tanking, as long as the absolute fundamentals of the company do not change, this is what you hope for. And if you're new to the whole investing game with dividends, you might not be ready for it. And I could see someone looking at the price going from 220 to 160. Why would I buy it? And if I do want to buy it, how do I know it's going to recover? Well, this is why dividend investing is great, especially when dividend aristocrats, companies that increase their dividend payouts over time, are such a beautiful thing. With 3M, it has a lot of big time investors. It's a $100 billion company. It's not just going to disintegrate into the ground without good reasoning. And you could say, well, what about GE? They had such a similar thing. They were such a huge company at one time. I believe it was fastest to 100 billion in market cap. Look at them. They just fell off the cliff, and now their dividends a penny a quarter. And yeah, I get that, but there were signs, leading up to say they were in a lot of trouble. First of all, their management team was horrendous. You could argue that 3M's current management team is not the best, but they're definitely better than what General Electric had. And General Electric, there was actually a very scary decline in free cash flow and operating cash flow. It kind of got cooked in the books a little bit GE did have to restate their accounting, so they weren't really doing too well in terms of accounting and keeping the books straight. And there was warning signs in the cash flow, in the payout ratio, and the how much they were giving to preferred shareholders in terms of dividends, and then how much they were giving left to the common shareholders. There was warning signs that GE, something wasn't right there. Some of their sections of their company were not performing up to expectations. In fact, some of them were just flat out bad. With 3M, it's a little bit different story at the moment. It's just poor guidance. Now, there is some weak aspects of 3M. Like I said, I'm not 100% confident in their management right now, but with 3M and companies like this, like Dividend Aristocrats, that have been around for such a long time. Let's hit the max chart here and say when it was founded. So I'm showing on the chart January 1st, 1970. I'm looking at Yahoo Finance right now. That 3M is being shown on the stock market and just increased their dividends for so many years now. A great aristocrat. And if you just bundle in your portfolio a bunch of aristocrats, you're hoping for opportunities like this where you can just buy low. Now, when you have the luxury of something like an M1 Finance where you can buy fractional shares, everything's a little bit different because you can do what I did. And because I bought 3M when it was at like 190, so obviously I took a big hit when it went down to the 170s and 160s. So pretty much every single day. And you can follow me on Twitter at Dividend Grinder, where I show every single trade that I do every single day. Since I invest every single day, you will see it post every single day. But that being said, I pretty much at that time put like $10 into 3M every single day. And the price just went down and down and down and down. And it just gets disheartening. Excuse me, especially if you're on M1 Finance because they use the money weighted average. So I was seeing literally like negative 30% next to my 3M number. And I'm just like, man, am I really going to put more money into this thing? Is it a falling knife? And you start to get a little disheartened, but you got to research it well. Make sure, are these just normal fluctuations in the price, or is there actual justification for it to be a falling knife? And it's very rare. It happens, but it's very, very rare for an aristocrat that's been along forever, that's weathered so many storms, that is doing so well to just all of a sudden fall off the map. It happened with GE, it happened with a couple other companies that I can't think of off the top of my head, but it's very rare. So you have to pretty much buy the dip. It's a expression that gets overused in my opinion, but when you buy the dip, when you buy companies that are on sale, as PPC Ian likes to say, look, at the time of 3M being $220, the starting dividend yield, if you bought at $220, was 2.8%. And then at its lows, when it was at like $160, you were getting a starting yield of 3.6%. And as a dividend investor, you're all about that yield and that yield on cost down the line. So when you get opportunities like this, you have to take advantage of them. I know it can be a little bit scary throwing money into a stock that's falling, but if you've done your research and you continue to do your research as the company's falling, reading all the articles as to why it's falling, and if you're just seeing like, oh, it's just the usual, company had a bad quarter and they slashed a little bit of their outlook, but everything else looks fine, then that is your moment to buy. This stems into the Warren Buffett quote of, be fearful when others are greedy and be greedy when others are fearful. Clearly, a lot of people feared 3M during this big drop, and it just kept selling and selling and selling. That's what happens in the stock market. It's a snowball effect. That's how recessions happen. It's when something starts to sell, other people get scared and they panic and they continue to sell, and the price gets lower and lower, and people get more scared and they keep selling. And it's just a snowball effect. It's almost the opposite of compounding dividends, where you start small and it just gets higher and higher and higher, and you get more cash flow coming into the portfolio. With the recession or bear market or flash crashes or whatever you want to call it, people just get scared and it just compounds as the price gets lower and lower. But when you're just looking at 3 and you're looking at some of the top line information in terms of like payout ratio, like right now on Yahoo Finance, it's showing a payout ratio 58.6%. Now, for a company that has been around as long as 3M, 58.6% is phenomenal, especially considering it's a well-established company. And if you take it against a company like Coca-Cola, which is also an aristocrat. It's been raising its dividend for how many years, and it's been around for so many years. Coca-Cola has a payout ratio close to 100%. In some quarters it goes over, some quarters it floats a little bit under, but around 100% payout ratio for Coca-Cola. And you look at 3M's, and they have, a 3.45% starting yield right now as of today, June 20th, when I'm recording this. Its payout ratio is 58%, very doable. You look at its cash flow. Right now on the balance sheet, it has $3.48 billion in cash sitting on the books, and then operating cash flow for the past 12 months of $7.3 billion, with free cash flow of $4.9 billion. Now their debt's a little bit higher than I'd like it to be at $17 billion, but when you get $7 billion of cash flow coming in, it's not the end of the world. And $3.4 billion in cash on the balance sheet side, not that bad either. Their financials overall, from a very high standpoint, look very good. They have a PE of around 18, which is, with these dividend aristocrats in times when the markets are at all-time highs, they're going to get a little inflated. And they have a forward projected PE of 16.7. This is all according to Yahoo. You just look at their revenues, just looking at it from a very topical perspective, and you look at their revenues from 2015 to 2018. You start in 2015 at $30.2 billion, then $30.1 billion the next year, $31.6 billion the next year, and $32.7 billion the next year. So increasing very slowly. You're not seeing any declines in revenue that would, indicate that something wrong is happening. The cash flow statement looks just fine. And the earnings, from 2015 to 18 went from $4.8 billion to $5 billion to $4.8 billion to $5.3 billion, all in earnings. Now, we go to the quarterly, and the first quarter lagged a little bit, only $890 million in earnings. And the revenue dipped just a little bit from the second, third, and fourth quarter of 2018. But at the same time, it's still making money. This is a long-established company. They're going to have, to do different ventures to gather in more revenue. They might try and acquire some companies. 3M just did acquire a company, and they sold off one of the divisions of the company. Someone on Instagram actually worked in that division that 3M got bought out from. The market actually liked this, but there's right now no signs of something drastic happening. And when you have these blue chip aristocrats, look, you really got to be interested in buying when they're low. That's the whole point of being a dividend investor. Being a dividend investor and being a value investor are almost hand in hand, and you want that higher yield, but at the same time, you don't want to buy dangerous high yields or yields on stocks that are just complete garbage. So 3M is the focus of the Diamond Dividend section. Now let's move on to the closing statement. It's time for the closing remarks. What am I going to finish with this time?
To infinity and beyond!
All right, that leads us into the closing statement. Now look, let's go back a little bit to the what irks me today section. Oh boy, do I love uploading YouTube videos. And let's say I did a video on, let's say PE ratios, just as an example, right? I'll go through the whole hour of recording myself when on the screen, and then the additional 30 minutes of editing, and then the additional hour of rendering, and then I'll put it up on the YouTube, which takes like 20 minutes to upload, and then I'll put all the tags and the monetization crap on it, which takes another like 30 minutes. So after this 3 to 4 hour process, my beautiful PE ratio video is up and on the interweb. And then let's say it's a 10-minute video, right? Normal 10-minute video. That's the common theme nowadays, is 10-minute videos to get that YouTube algorithm and the monetization, so you can add more monetization stops on your video. But so I put out a 10-minute PE ratio video. Well, little do I know, 2 minutes after uploading the video, where obviously it is physically impossible for anyone to have watched the entire video, as it literally just came out 2 freaking minutes ago and it's 10 minutes long. Here comes that beautiful comment that pretty much every financial YouTuber gets on a daily basis. Hey, great video. What do you think about this stock?
Nope.
And oh my God, something in my brain just wants to punch the damn monitor And look, it's it's honestly more me than it is like an actual problem. I just get really irritated. I don't know why I get irritated. I just do. But I honestly am polite and I give my honest opinions on whatever stock they ask me to do. I either say like, look, I haven't researched it, or look, I think it's garbage, or look, it's actually a solid stock. Like, and this is why I believe it's a solid stock. But nonetheless, it does irk me, and that you just get that. It just irritates me. It's just like,
You did all this work on the video, and that's fine and dandy, but it's not what I want. What do you think about my issues and my stocks? I don't have time to research. You do it for me.
What was your video about again? Hey, great video, by the way. Anyway, so why did I go into that rant when this is a closing statement? It's not meant to be an evil rant or anything. What I mean is, it's hard to actually honestly give an opinion when someone says that. So let's say, let's calm it down a little bit, and let's say, someone asked me, hey, what are your thoughts on, let's say, Pfizer? A stock that I have absolutely no connections to. I honestly barely know anything about Pfizer except that they're in pharmaceuticals, blah, blah, blah. Anyway, so let's say the person says, what do you think about Pfizer? And it's really difficult to give an honest opinion because you don't know that person's goals. And if you ever do see comments on my videos like, what do you think of this stock? 95% of the time, my first sentence in response to it will be, it depends on what your goals are. And guys and gals listening, I cannot stress this enough. Your goals, what you want to accomplish with your portfolio, with your investments, long-term or short-term, what kind of outlook do you have? It should dictate everything. And when you ask someone an opinion about a stock, you have to give the full story of what is making you consider that stock, why you think it's beneficial for yourself. Otherwise, who knows what it can mean. So someone investing for growth would be like, why the hell would you even consider Pfizer? And then someone who's in it for long-term dividends would be, I think Pfizer's fantastic. You should definitely do it. You have to learn somebody's goals. Now, usually if they're coming onto a dividend channel, it's going to be like, I just want dividend income, blah, blah, blah. But still, what are your goals? Why would you invest in that company? Does it fit your master game plan? So for me, I'm very impatient, and I would argue that my yield on my portfolio right now, which is around 5.1, 5.2%, it's a little high for normal, but I do own a lot of REITs, so it's not like it's completely out of hand. It's not like I'm yielding 9 to 10% or something ridiculous like that, something unsustainable. It's a lot of REITs, and now I have utility exposure, so obviously there's higher percentage yields on those just naturally. And then I have my PPC EMPI, which is pretty much essentially dividend aristocrats, and newly soon to be probably dividend aristocrat holdings. So what I'm trying to get at is have your goal. So with my goal, I want to generate a lot of cash flow. That's why I have the cash flow challenge on my channel. I want to get to $500 a month on average generated from my portfolio. And if you're just listening to the podcast and you never follow me, my YouTube channel is Dividend Grinder, just a space in between. It's just Dividend Grinder. But so for my goals of getting to $500 a month in dividend income, obviously I'm going to be a little bit more aggressive on the dividend yield side than other people. So, I have holdings like a Gaming and Leisure Properties, like a Main Street Capital, like a Gladstone Investment Corp, like an HYHG, stuff that I necessarily would not recommend for a large majority of people. But it depends what your goals are. It depends what your risk tolerance is. It depends what your longevity in the market is going to be. There's so many factors that go into it. So when you just throw out this blanket comment, like, what do you think about this stock? I mean, I don't know. If you ask me, what do I think about Google? Well, if you're a dividend investor, I think it sucks because it doesn't pay one. But, in the back of my head, it's like, well, Google is like probably the greatest financial statements I've ever seen in my life. But it's like, if you're a dividend investor and your goal is to just strictly have dividend income, well, then what's the point of holding Google? So you have to just, and I have to remind myself of this, like, look, I am a dividend investor. That is the whole point of me investing into the stock market, is to get that cash flow from my investments without me having to do anything. And sometimes I just have to remind myself that. And that's why, I sold my Google and I sold Amazon, and I just bought BST, which is a fund that holds these. So I get the distribution, a monthly distribution, while still having some access, some oversight, some exposure. That's the word I was looking for. Some exposure to Google and Amazon while still getting that distribution. That's the whole point of my channel, right? Like I'm dividend grinder. I want the cash flow coming into the portfolio. But everyone's goals are different. If you're very young, if you're 21, just starting in the stock market, your goal should be different than someone else's. Meaning, like, if you're in it for the very, very long term, well, then you're going to buy the more blue chip, aristocrat type stocks, the McDonald's, the Johnson & Johnson's, the Pepsi's, the Coca-Colas. You're going to buy more of those stocks. Or maybe you want a little bit more growth, then you're probably just going to buy a low-cost index fund like a VOO, like an SPY, like an SPHD, like a DIA. Everyone has different goals, and you have to really harp on what your own personal goal is. And if you don't have a goal, you're gonna fail in the market. If you don't have any goals in the market, then what are you doing in it? You don't have any blueprint for what you want to do with your portfolio. Even if you're completely clueless and you start out at 21 and you just invest in VOO and you let it sit there for 25 years, that's fine. But after 25 years, do you really want to be in that same holding? What are your goals? Do you at that point want to convert into more, cash flow friendly stocks? Or do you just want to take it out at that point? Has it grown enough for your liking that you want to take it out? You have to have both short-term and long-term goals for your portfolio. And if they're all short-term, then it's going to be completely different investing than people who are all long-term. When you invest in dividend stocks, you're pretty much long-term by nature, unless you're freakishly aggressive like me and you're just kind of a gambler at heart and you're just going for it. That's why I suggest no one ever copy my portfolio. But I love showing it because I know I'm unique with my trading habits. I change my portfolio more than I change my damn shirt, but that's all right with me. And I know it's entertaining for people. And quite frankly, if I screw up quite badly, it's going to be a great learning experience for people who watch my portfolio and see what happens. And they can compare it to what they're currently holding. How did their holdings hold up against mine? That, if a bad case scenario happened, if mine crashed, how did their portfolio hold up? Great learning lessons around for both the audience and myself. But it's part of my goals to get cash flow and get cash flow quickly, especially if these markets are at all-time highs. I really want to generate more cash flow. I'm trying to buy more higher yield stocks at the moment, along with spiking up my aristocrat type stocks, something like a McDonald's and Johnson & Johnson, because those will stand the test of the recessions, which I believe we are due for one in 2020. We'll see how it happens. No one can predict the market. This has been the closing statement, and this has been the first official podcast of the Spicy Dividend. Hope you enjoyed it. I know I was supposed to have a camera. I actually ordered a camera off Amazon so you could see my lovely getting fatter face. God damn you, Godiva chocolate. But anyway, the camera, either I'm an idiot or the camera sucks, but every time I upload, even in 4K, it looks blurry as hell. And I'm like, I'm not dealing with that. It's going to be so not worth it to try and upload that, and it's going to render for 3 hours. And the whole point of the podcast is to listen to the voice, right? It's almost like your own little radio station and take it on the go wherever you want. But I hope you enjoyed the Spicy Dividend. Leave any comments or suggestions, or if you want to hear something in the next episode of the Spicy Dividend, down in the comments below, where if you're listening to this on YouTube. If you're not listening to it on YouTube, if you're listening to it on another platform, you can reach me at Instagram at dividend_grinder or at Twitter at dividendgrinder. No spaces or underscores, just at dividendgrinder for Twitter. So hope you enjoyed this. I will see everyone in the cash flow challenge on Monday.